Stock Screeners, Lecture 19. Lecture Outline. Hello, welcome to Lecture 19 of Equity Master Secrets. This lecture is on stock screeners. So now we've finished our lessons on valuation and that module. So now we're going to move on to a new topic, and this topic will be stock screeners. So the first thing we're going to talk about is what is a stock screener. The next thing we'll do is talk about the different types of stock screeners. So in particular, we'll go through three particular types. We have the Benjamin Graham stock screeners, the Warren Buffett stock screener, and the Magic Formula stock screener. Then we'll talk about some things to keep in mind when using stock screeners. And finally, we'll conclude. Okay, let's get started. What is a stock screener? So in the modules so far, we have covered the qualitative and quantitative aspects of value investing that will enable you to evaluate a potential investment. Right, so we've talked about how to value a company, how to analyze its management, so on and so forth, and all of these things should put you in a good position to actually go ahead and make an investment. So you should now be in the position to apply the principles of value investing for your own stock portfolio. So at one point you might have this question, well, how do we get started to begin with? So there are really two broad approaches to fundamental investing. We have what's called the top-down approach and the bottom-up approach. The top-down approach places greater emphasis on the macro factors, right? So that would look at, for example, what's happening to the economy and perhaps what sectors are doing well within the economy. So first thing you would do is evaluate the macroeconomy, right? So you would say, well, are we going into a recession? Are we going into an expansion? And then based on the analysis of macro trends, we would pick up a sector or sectors that would be likely beneficiaries, right? So if we think a particular sector is going to do well, then we would go ahead and look at that particular sector, right? And that's going to be based on the analysis of our macro trends. And then within those sectors, an investor would pick up fundamentally sound companies, right? So we would start with the macroeconomy and say, well, within the macroeconomy, given our outlook over the next few years, what sectors do we think are going to do well, right? And that can, vary depending on the current business cycle or just, technological changes, etc., or regulation, or all kinds of things that might impact one sector over another. We pick some sectors that we're going to do well, and then in those sectors we try and find companies that are undervalued and that are likely to have strong stock price performances. The bottom-up approach. So just to conclude a little bit on the top-down approach that we just talked about, the top-down approach is logically sound, but it may depend on certain macroeconomic assumptions that may or may not materialize. Right, so often when we're trying to do this top-down approach, we may need to make forecasts about what we think the economy is going to do. We have to forecast what sectors we think will do well, and this is not always an easy task, right? Our forecasts can be wrong, and we have to make assumptions to make these forecasts, and these could turn out to be wrong as well. So the other approach is the bottom-up approach, and as you can imagine, this starts at the bottom by looking at specific companies. So in the bottom-up approach, we have a more company-specific focus, and the investor's investment decision would be primarily based on the individual merits and demerits of a stock. Right. So rather than worrying about what's happening to the big picture, we only focus on the individual companies, or we primarily focus on the individual companies. So some of the most successful value investors, including Warren Buffett, have followed this investment approach, right? So this bottom-up approach of starting by looking at individual companies. And even though when we do this bottom-up approach, it does not mean we should ignore larger sectoral and macro trends, right? The fact is that macro trends do matter, and sectoral trends do matter. They are going to impact the stock price. So we are still going to be aware of what's going on at the macro level. We'll be aware of the risks in the macro level, but we're going to invest from the bottom up, which means that we're going to find companies just by looking at the individual merits and demerits of a company, while only being aware of the big picture risks, right? So that's the bottom up approach, and this lecture is going to be focused on following this bottom up approach, and stock screeners will be exactly just how to do that. the need for a stock screener. So let's suppose we now decide we're going to follow the bottom-up approach. Okay? How do we go about selecting the companies that we want to research on? And the difficulty with the bottom-up approach is that if you're starting with individual companies, there are just lots of companies out there. So for example, on the BSE, on the Bombay Stock Exchange, there are more than 5,000 companies listed, right? And that's a lot of companies, right? If you think about, what we've been learning in this course so far, like how to do evaluation of a company and how to, analyze it qualitatively as well, you can see it takes a lot of effort to actually analyze a company, right? So we certainly cannot go about and do this for all the companies that are available. So it is humanly impossible to peruse through the business and financials of every company, right? It's just very, very time consuming, and it's probably a bad way to actually go about this if you want to be efficient with your time. In order to remedy this problem, we use what is called a stock screener, right? So a stock screener is going to be something that we use to filter down this large list of companies into a more manageable amount of companies. So stock screeners are financial and valuation filters, right? And these help you zero down on companies that could be prospective investment candidates, right? So essentially you're going to take this big list of 5,000 companies and narrow this down to a much smaller list based on some financial and valuation filters. And this can be useful to eliminate all the companies that don't fit the prerequisite financial criteria, okay? So again, the idea is to take these large set of companies and narrow it down to a smaller set, and we're going to be eliminating companies that don't meet some prerequisite financial criteria. We'll talk a little bit about what those financial criteria are in the rest of this lecture. Types of stock screener. So the next question is, how do you choose the right stock screener, right? So how do we actually go ahead and, filter these companies, and on what basis do we do so? And ideally, the choice of the screener must reflect your investment philosophy, right? So in the lecture outline, we said we'll talk about a few different types of screeners, and each of these will reflect a slightly different investment philosophy. And the various parameters that you use in a stock screener are business and performance attributes that you expect a prospective stock to possess, right? So we want to look for things that are consistent with what you think is important for an investment to be successful. You can create your own stock screener based on factors that you believe are critical in a sound business, right? So for example, you could have a stock screener that's based on, let's say, the company's book value relative to its market value. You could have a stock screener based on a company's PE ratio. You could have stock screeners based on its debt to equity ratio. So all these kind of financial variables, that you could get from a company's accounts and the stock prices in order to actually filter them, and compare one against the other. And these kind of quantitative criteria, we can use it to narrow down the large list of companies. And that's what the stock screener is going to do. So in the coming slides, we're going to discuss some important stock screeners based on the principles of some noteworthy value investors. Right, so we'll talk about Benjamin Graham stock screeners, which there are three of them. Then we'll talk about the Warren Buffett stock screener and the Magic Formula stock screener. So we have 5 different stock screeners we're going to go through. And like I said, there are other stock screeners out there. You can create your own as well. And when you see how these work, you'll actually see that, it's not too difficult to actually create your own screener based on the factors that you think are important. But here are the ones we're going to show you that, are commonly used and we think are important as well. Okay, let's carry on, and now let's talk about the stock screeners themselves. Benjamin Graham stock screeners. Benjamin Graham, also known as the father of value investing, so he was one of the first to actually pioneer the approach of value investing, largely focused his stock picking approach on finding deep bargains, right? So finding stocks that were really undervalued and very, very cheap. And during his earlier years, his investment strategy was to buy stocks that were available at a price below their net current asset value. And this methodology, as you can imagine, produced very good results. However, after the long bull run commenced in 1949, So this is referring to the U.S. stock market where Benjamin Graham operated. Such bargain opportunities became increasingly rare. All right, so to find companies that were trading well below their net current asset value became difficult to find. So in 1973, 3 years before he passed away, he presented an elaborate study which showed that in every 2-year period between 1958 and 1971, stocks had either risen or fallen by at least 33%. Right, so this was looking at, well, over the course of these, over the entire sample, in a 2-year period, how much are individual stocks moving around, right? And even if the market's not moving by a huge amount, individual stocks are moving a lot, right? So stocks are rising or falling by at least 33% is what he found. So this encouraged him to find a quantitative framework that would be able to take advantage of such volatility in the stock market. Right? The fact that a lot of individual companies are moving around a lot, even over a short time period, that means you should be able to make investments, buy it when it's low and sell it when it's high, type of approach, right? So to take advantage of volatility, how do we do that? And how do we buy companies when they're cheap and then sell them when they're expensive? And with a given volatility, there should be plenty of opportunities to do so. Benjamin Graham stock screeners. So as per Graham, in order to create this quantitative system, it needs to be satisfy some criteria. The system needs to be logical, easy to implement, and capable of producing satisfactory financial returns. So which financial criteria would be able to fulfill all 3 conditions across the different time periods? So based on the principles and criteria laid down by Graham, what we're going to do now is discuss 3 stock screeners that could help you pick value stocks trading at a steep discount. Right, so Benjamin Graham came up with all these various criteria, and this translates into 3 different stock screeners, okay, that fulfill the criteria that they're logical and easy to implement in order to filter down a large list of companies, right? So the idea is to now use this to come up with a more manageable list of companies that meet these criteria that we can go ahead and actually consider investing in and evaluate in a lot more detail. Benjamin Graham stock screener number 1. The first stock screener that we're going to look at is going to have 2 parameters, right? The first is the price to book value ratio, and the second is the debt to equity ratio. So essentially we're going to be filtering companies based on these 2 parameters. And the conditions are as follows. So the first is that the stock must be less than 2/3 the book value per share. Right, so this is kind of looking at, finding those stocks that are trading at a discount to their book values. So we're saying that the market value of the company must be less than 2/3 the book value of the company. And this is so that we have, a considerable margin of safety. And the second parameter is that the debt to equity ratio must be less than 1. Okay, and basically this also means that the amount of debt must be less than the amount of equity, right, if the ratio is less than 1. And in addition to these conditions, we also apply some additional ones, such that the price to book value must be greater than 0, and the debt to equity ratio must also be greater than 0. Okay, and these are kind of more technical conditions. But you can see here that these 2 conditions we're essentially looking for companies that are trading at a large discount to their book values, and also don't have excessive levels of debt. Right, so these are the kind of 2 things we want to look at in order to filter down the list of companies. So the 0 conditions, okay, that we must have the P over BV bigger than 0 and D over E bigger than 0 is that we eliminate companies with negative net worth. Okay, so typically if a company has negative net worth, then its book value will be negative, then its price to book will be negative as well, and we obviously want to avoid that situation. Okay, so we have these 2 conditions, and with these 2 conditions, we should be able to filter the large list of companies into a much more manageable one. Benjamin Graham stock screener number 1. So let's now talk a little bit more in detail of how exactly the stock screener works. So as we saw in the previous slide, the first parameter in the stock screener is the price to book value ratio. And this ratio gives you the relationship between the stock price and the balance sheet, right? So the book value is something that you get from the balance sheet of a company. So the way to think about book value is to think of it from the perspective of, well, if the company were to be liquidated, right? So that means that the company takes all its assets, it sells all of them, and then it uses its proceeds to pay its liabilities. What would be left over once we do that, right? So that would be what is left over for equity holders. Okay, so it's equal to total assets minus total liabilities. And the book value is also can be called a net worth, and this is the shareholders' funds, right? So this is what's left for equity holders once the company would be liquidated, if that's what happened to it. And if we set this condition that to screen stocks that are trading at less than 2/3 of their book value, we're looking for stocks that are trading at a deep discount to their net worth, right? So we're saying, well, a net worth is what would be left for equity holders based on the company's accounts, and we want to find a stock that is trading at less than 2/3 of this, right? So that's trading at much cheaper than its book value. And the second filter, the debt to equity condition, this is just so that we make sure we avoid highly leveraged companies. Okay, because highly leveraged companies, as we've seen earlier in the course, can be very dangerous and very risky. So typically we want to, find companies trading at a large discount, but also, that are have not very high leverage, right? So that have debt to equity ratios less than 1 or debt less than equity. Benjamin Graham Stock Screener number 1. So now here we are in Excel, and what we've done is apply the stock screener to our list of stocks, and we've shown you what has come up as a result of that. So in this case, our criteria, as we've just seen, is that we want the price to book value ratio bigger than 0 and lesser than 2/3 or less than 0.67. Okay, so you can see the price to book value ratio over here, and it's always less than 2/3 and always positive. And we want the total debt to equity less than 1, but also bigger than 0, which you can see we have here as well. So the actual list of companies that fulfill these two criteria are quite large, so we've applied some additional filters. The first is that net sales must be bigger than rupees 5,000 million. So all of these are companies which have sales of greater than 5,000 million. And finally, we've also then taken out the highest debt to equity companies to arrive at a final list of 20 companies. So we've actually applied some additional filters just to narrow the list down a little bit, because the first two criteria still give us a big list. So we've taken companies with high enough sales, and also then from that list taken out the highest companies with the greatest debt to equity ratio. Okay, and then here you can see essentially the 20 stocks that we come up with based on this criteria. Right, so the stock screener, as you can see, is pretty simple to apply, right? As long as you have these statistics for each company, so you have the price to book, you have the debt to equity, and you have the net sales, then it's fairly easy to create these filters. So here are some additional notes about the first stock screener. So firstly, the price to book value ratio of less than 1 is not always likely to be a safe investment. So that's not necessarily a guarantee of a safe investment. The actual liquidation value of the company, or especially of certain assets, might be lower than the value that's stated in the balance sheet. Right? So sometimes things can be valued based on a historical value, which may not be accurate today. If the company is making heavy losses and unlikely to recover soon, that could result in further erosion of book value. Right? So that can destroy value if the company is making losses. And again, an investor looking at investing based on Benjamin Graham's principles must follow a diversified portfolio approach, so that a couple of bad investments does not, cause any large losses. All right, so let's now go ahead and we'll go back and talk about stock screener number 2. Benjamin Graham stock screener number 2. So now let's move on to the second stock screener. Okay, so the first one we saw had the price to book value and the debt to equity ratio. The second screener has two different parameters. One is the same. The first is the price to dividend yield ratio, and the second is the debt to equity ratio. And here are what the conditions are for this particular stock screener. The dividend yield must be at least 2/3 of the bond yield or greater. Okay, and we'll talk a little bit in the next slide about what this condition means exactly. But essentially, dividend yield reflects, when you hold the stock, a stockholder gets paid dividends, and the dividend yield is the percentage of is the dividend divided by the stock price. That's kind of the return you get, the dividend return you get from holding the stock. And the second condition is that the debt to equity ratio is less than 1 and also greater than 0 as mentioned previously. Right, so this is again the same condition as before, and again we're trying to make sure that we avoid highly leveraged companies. Right, so in both cases it just serves to filter out companies that are highly leveraged. We don't necessarily we aren't necessarily using debt to equity ratio to actually say that the company is very cheap or undervalued. That's really the first condition, right? So in this case, the dividend yield is going to tell us which companies are the right ones to go for. Benjamin Graham stock screener number 2. So now let's talk a little bit more about the dividend yield and what exactly it means. The dividend yield is a financial parameter that shows the returns earned on a stock investment from the dividends. The way we calculate the dividend yield is to take the dividend per share and divide it by the stock price. Okay, so if you're a stockholder, you would typically receive some dividends. Most companies pay dividends, and the dividend yield is just the dividend per share divided by the stock price. So suppose we bought a stock X at 100 rupees per share, okay, and the stock paid a dividend of 8 rupees per share. So then the dividend yield would be 8%, because we just take 8 divided by 100, which is 0.08, times it by 100 to put it in percent form, we get 8%. And why exactly is the dividend yield important? The dividend yield ensures that investors earn a return on their investment even in the absence of stock price appreciation. Right, so when you hold a stock that pays dividends, that's income that you get from holding the stock, regardless of what happens to the stock price. Right, so when you buy a stock, you are a part owner in this company, right? And the dividends is typically a share of the company's earnings, company's profits, and as a part owner of the company, you're entitled to receive that share of the company's profits. And it provides a steady stream of income for long-term investors without them having to sell their stocks, right? So this is why, from a valuation perspective, dividend yield is important, because it does provide income, right? So it adds to the stock return that we get, and it provides us income then that we don't actually have to sell the stocks in order to get this income, right? So that's why the dividend yield is something that we like to look at, and something that is worth looking at from the perspective of screening stocks. Benjamin Graham stock screener number 2. So going back to the screener, let's talk about what the condition said exactly. So the condition said that the dividend yield of the stock must be at least 2/3 of the bond yield or greater. The corporate bond yield in India is close to about 10%. So the corporate bond yield that refers to what would you earn from buying a company's bonds, right? So if a company is borrowing by issuing bonds, what is the return that this investment is going to pay, right? So how much would you earn from investing in a company's bonds? So in India, this current figure is about 10%. And given that we have a bond yield of 10%, we get that the dividend yield must be 6.7% or greater, right? So we're saying the dividend yield must be at least 2/3 of the bond yield. 2/3 of 10% is 6.7%. So our stock screener would become that we're looking for companies which pay a dividend yield of 6.87% or greater. So the way to think about this is that the dividend yield is essentially saying we're looking for companies that pay a high dividend yield, right? So given the stock price, you get a higher return from dividends for this company. That's essentially what this stock screener is trying to do. Right, it's trying to say, well, I want to find companies where dividend yields are high, right? Where dividend yields are at least 2/3 of the bond yield or greater. So obviously, higher dividend yields are even better because it means that my return from holding the stock is even higher than it would be otherwise. Benjamin Graham stock screener number 2. So now we're in the second stock screener, of Benjamin Graham. So in this time, our criteria is that the dividend yield must be greater than or equal to 6.7%. Right? So we're saying the dividend yield should be at least 2/3 the bond yield. The bond yield we've assumed to be 10%, so we want the dividend yield to be at 6.7% or greater. And finally, we want a debt to equity ratio of less than 1. So in order to create this list, again, we've done some additional filtering. So the first is that we want companies with net sales of over rupees 2,000 million. Okay. So that's the filtering we've done, and then as a result of that, we come out with this list of companies. And again, you can see that you still get a good list of companies even after you apply these criteria. And you can see the dividend yield, and we've actually sorted this by dividend yield. So the companies with the highest dividend yield are first, and then it goes consistently lower. So there's only really a few companies which are very high dividend yields, but then there's quite a significant amount of companies once we start over here, going from a dividend yields of around 9, and there's a lot in the range of 7. Okay, and again, we've taken a size screener by saying must have net sales over rupees 2,000 million. So here are some important notes that are useful for understanding these dividend yield stocks. So the first one is that before we invest in dividend yield stocks, we should find out if the company has been consistently paying dividends, right? So are these just one-off things, or is it something that's regular? We also want to normalize the dividend payout by removing special dividends, right? So these one-off types of dividends that we don't expect to occur in the future. And we should really only be investing in the dividend yield stock if we think the company can maintain the current level of dividend in the future, or otherwise they would increase it. The next point is that any structural decline in a company's fundamentals could impact its ability to pay dividends in the future. And finally, an investor looking at investing based on Graham's principles must follow a diversified portfolio approach so that a couple of bad investments does not impact the overall portfolio. Okay, so these are just some important notes to keep in mind when we're looking at high dividend yield stocks. Alright, let's now go back and we'll talk about the third stock screener. Benjamin Graham stock screener number 3. So now let's go on to talk about the last of the Benjamin Graham stock screeners. And this stock screener has two parameters. We have the earnings to price ratio and the debt to equity ratio. So the debt to equity ratio is a consistent one across all of them. The other one, the one that's changed, is now the earnings to price ratio. And the conditions are as follows. The earnings to price ratio must be at least twice the bond yield, and the debt to equity ratio must be less than 1. So this is kind of following a pretty similar format to the previous case. So previously we had the dividend yield must be 2/3 the bond yield, and now we have the earnings must be at least twice the bond yield, right? So the earnings to price ratio is going to look at, well, how much earnings are we getting given the price, and this should be at least twice the bond yield, right? So again, it's saying we want companies which have high earnings to price ratios, and the higher the better. Benjamin Graham stock screener number 3. So the earnings to price ratio, which is also known as the earnings yield, is nothing but the inverse of the price to earnings ratio. So we've seen the price to earnings ratio in a lot of places, right? When we look at valuation, and typically when you look at a summary of a company's financial statements, the price to earnings ratio, that compares the market price per share relative to the earnings per share, is a very commonly one used in valuation. So the earnings to price ratio is just the inverse of that, okay? And it's also referred to as the earnings yield. And the first condition of the screener said that the earnings to price ratio must be at least twice the bond yield. So in practice, what this means is that if the bond yield is 10%, then the earnings yield must be at least 20%, right? So this is saying that the amount of earnings I get per share, okay, is 20% of the current stock price. So suppose we have a stock that's trading at 100, okay, and we want to ensure that the earnings yield is twice the bond yield. So we have a bond yield of 10%, so we want an earnings yield of 20%. If the stock price is currently at 100, it means that we want earnings per share of 20, right? So that's 20% times 100. And a 20% earnings yield, if we want to think about, well, what's the P/E ratio of this company? Well, we would just take the inverse of this, and this would be an earnings multiple of 5 times, right? Which is just 100 divided by 20. So essentially, the equivalent way to say this is that we want P/E ratio less than 5. So we can rephrase this first condition as saying a price to earnings ratio of 5 or less, right? So the screener, as it's typically applied, is saying, well, we want an earnings yield of at least 20%. Alternatively, the same thing would also be that we want a price to earnings ratio of 5 or less. Benjamin Graham stock screener number 3. So now we're looking at the third stock screener, and in this case, our criteria is as follows. We want the earnings to price ratio bigger than 2 times the bond yield. Okay, so that's the bond yield is 10%, so we want the earnings to price ratio greater than 2 times 10%, greater than 20%. That's equivalent to saying the price to earnings ratio less than 5 times. Okay, so we've kind of sorted things out by price to earnings ratio. So we want price to earnings of less than 5 times, and we also want a debt to equity ratio of less than 1. And we have then applied an additional filter where we take out companies with net sales less than rupees 5,000 million. So all these companies have net sales of greater than rupees 5,000 million. Okay, and we've also removed the highest debt to equity ratio companies. So this is the same type of criteria that we had in the first stock screener for filtering additional stocks. And the reason we apply these is that it's just not always, you just still end up with a very large list with just the initial criteria. So you need an additional filter to narrow the list down. Okay, so let's look at some of the important notes for this. So firstly, if there's a structural decline in the company's fundamentals, this could impact future earnings prospects, and so a low PE does not necessarily mean it's cheap, right? So we have to think whether the future earnings are going to be falling or not, right? Sometimes the PE ratio can fall in anticipation of a drop in earnings later on. So we need to check that what's going on with the company's fundamentals. And we also need to look at the PE ratio that the company has historically had, right? So we can look at the range of the PE ratio over time, and if the PE has come down due to some temporary fixable challenges, that could be a value buy. And once again, the same note as we had before, that if we're looking at investing based on Benjamin Graham's principles, we have to follow a diversified portfolio approach in order so that a couple of losses don't hurt us. Okay, let's now go back into the PowerPoint. Warren Buffett stock screener. So now let's go on to talk about the fourth stock screener we'll look at in this lecture, and this is the Warren Buffett stock screener. So as you likely know, Benjamin Graham's most astute student was Warren Buffett, and he kept the principles of value investing taught by his mentor intact. But he did redefine his approach a little bit, so his approach is a little bit different to Graham's approach, and particularly to focus more on quality. So the Warren Buffett approach is largely to look at companies that have a very durable economic moat and are trading at fair valuations. So we've kind of seen what an economic moat is, and a way to think about it is that we're looking for companies which have really good future potential earnings because of their moat, and they're trading at fair prices. In comparison, Graham's approach is looking for companies that are extremely cheap, rather than companies that are fair valuations but have strong moats. So this focus on the economic moat means there's more of a focus on a firm's qualitative factors. So that's kind of the one of the features of Warren Buffett's approach and how it differs from Benjamin Graham's approach. So obviously now, if we think about, well, how do we create a stock screener for Warren Buffett's approach, taking this into account? So our goal now is going to be to understand, well, what are the typical qualities of a stock that Warren Buffett would buy, and how an investor could create a screener to find such companies. So this could be a little bit more tricky than the Benjamin Graham screener, simply because Warren Buffett focused on qualitative aspects, right, which are obviously more difficult to quantify when we're actually creating a screener. Whereas with Benjamin Graham, it was quantitative aspects in the first place, so that makes it easy to actually screen out companies. But of course, we can still do it. So let's go ahead and see how exactly the Warren Buffett stock screener works. Warren Buffett stock screener. So, in order to actually quantify, Warren Buffett's approach, it's not obviously something that you can do perfectly because, these are qualitative factors that we're looking at. But we can certainly try and give, a reasonable approximation to what a Warren Buffett stock might possess. So, we've identified some key parameters that can help you zero down on stocks that possess the attributes that a typical Warren Buffett stock is likely to possess. So the first one is high return on equity, right? So this is a signal that, the company has a very high return, perhaps it has an economic moat as well. Then we're looking at a strong dividend payout ratio, right? So companies are also able to pay large dividends because they have strong earnings. We're looking at for a low debt to equity ratio, right? We've talked about how high debted companies are significantly more risky than low debt companies. And finally, a fair price to earnings ratio, right? So this is looking at, well, we want a stock that produces, has a strong economic moat, so has these great attributes, which also has a fair price. So that's the fair price to earnings ratio. And now let's go through the results of Equity Master's Advanced Stock Screener. So we'll look at, how we come up with this list of stocks. And we actually have a tool on the Equity Master website where you can actually do this for yourself. So we'll take a look at that as well. Warren Buffett stock screener. Okay, so now here we have back in Excel, we have the Warren Buffett stock screener. So the four things that we're looking at to screen companies are going to be the return on equity, debt to equity ratio, the dividend payout, and the price to earnings. So the criteria that we've applied is that we want, firstly, for return on equity, a 5-year average return on equity greater than or equal to 20%. Okay. And then we've sorted these by return on equity, all these stocks. Then we want a 5-year debt to equity ratio less than or equal to 0.5 times. Okay, so debt to equity ratio of less than 0.5. An average 5-year dividend payout ratio greater than 20%. So dividend payout ratio here bigger than 20%. And finally, a trailing 12-month price to earnings multiple of less than 15. Or 15 or less. So again, PE ratios of less than 15, indicating the fair price. So some important notes to keep in mind. The results of the screener reflect only the company's past performance. So if the company's fundamentals are deteriorating or its economic moat is eroding, then we would have to say that this may not qualify as a Warren Buffett stock. The other thing is that there is no standard yardstick to determine Warren Buffett type of stocks, right? That's because of its inherent qualitative factors. So you can create your own screener based on your understanding of Buffett's philosophy if it differs. And you can experiment and derive multiple results by changing the criteria on Equity Master's stock screener. So this link here is Equity Master's stock screener. So if you click on it, it will then take you to the website where you can do this. And this is what this advanced stock screener looks like. So, for example, you can select Warren Buffett type of stocks, or you can also select on all these types of criteria and number of results, and then you can, for example, set, for example, sales, bigger than or equal to something, or you can set some other, criteria here bigger than or equal to something, and also do it for each of the years. So I definitely encourage you to have a look at this, and you can play around with it and see what how different filters give you different lists of stocks. Magic Formula Stock Screener. So we've now just seen a stock screener that was derived on the basis of Warren Buffett's value investing principles. Okay, we saw the Warren Buffett stock screener. Now we're going to talk about the Magic Formula stock screener, which is the last stock screener we'll talk about in this lecture. And as we said, this was just one of the various ways of finding a quantitative interpretation of Warren Buffett's stock picking approach. So now we will go through something called the Magic Formula stock screener. And this has been created by Joel Greenblatt. So this is Joel Greenblatt's Magic Formula stock screener. And in this stock screener, Greenblatt has tried to arrive at a quantitative translation of Buffett's investment strategy of buying a great business at a fair price. Okay, so as we said, how you create the screener is determined on your interpretation, right? And fundamentally, that's because Warren Buffett uses a lot of qualitative factors in order to make investments, right? So things like evaluating a company's management. And that's something that's, quite difficult to capture in a stock screener in a quantitative way. But we can still do the best we can based on the principles that we want to buy great businesses at a fair price, right? So the goal of this magic formula screener is to, really try and work out how exactly can we quantify, Buffett's investment strategy of buying a great business at a fair price. All right, so we'll go ahead and look at how this works. We'll spend a bit of time on this one because this one we believe is quite important, and then we'll take it from there. Magic Formula Stock Screener. So let's start by focusing on, what are the two key factors in Warren Buffett's approach? Well, we're looking for a great business and we're looking for a fair price. So we'll try and break these down and see how we can quantify each of these factors. So let's think, how can these qualitative factors be defined in quantitative terms? So Greenblatt uses the following algorithm to arrive at a financial metric that would be an approximate translation of the two qualitative terms. The first is a great business, right? So as per Buffett, a great business is one that earns a high return on capital, right? So essentially we're saying we can call a company a great business if given its amount of capital, it can generate a very high return, right? So this indicates that it's making, very high profits, and perhaps, the industry's, doesn't have the competition that's going to erode away its profits. And these are some of the things that allow it to earn a high return on capital. So there are various ways to look at a company's return on capital, right? So we'll look at a few different types. But this is one of the first things we want to say. How exactly do we distinguish what is a great business? And the metric that we're going to use when we're looking at a great business, we want to say, a great business is a company that has a high return on capital. Okay? So now let's go ahead and think about the various ways to look at a company's return on capital. And we'll look at how exactly does Greenblatt define the return on capital. Magic Formula Stock Screener. So the return on capital is defined as the earnings before interest and taxes, or EBIT, divided by the total capital. So this is looking at, the company's earnings before we pay interest and taxes, and divided by our total capital. And as per Greenblatt, capital is equal to net plant, property, and equipment, and net working capital. Okay, so these are the three factors that will make up the total capital. So it is also noteworthy that he has excluded excess cash and interest-bearing assets, right? So we're not actually taking the total amount of the company's capital. If we were to look at, say, the company's total capital, we might include things like cash and interest-bearing assets. But the screener only looks at net plant, property, and equipment, and net working capital. So in other words, he has only included those assets in his definition of capital that are actually used in the business to generate a return. Right, so when we're thinking about return on capital, we want to exclude capital that isn't actually used to generate the return in the first place. Right, so if a company has excess cash, or interest-bearing assets, that's just like the company's savings or in some way, and they're not actually using that in order to generate the return. Right, so we'd want to exclude these things from the capital when we're calculating the return on capital. So that's the first thing to look at when we're trying to figure out what exactly is return on capital in this framework. Magic Formula Stock Screener. So fair price is the second thing we want to look at. And as we've seen, Buffett prefers a great business at a fair price than a fair business at a bargain price. So the second approach is more the Graham approach. And let's see how Greenblatt defines the financial parameter that would determine a company's fair price. Right, so how exactly do we come up with understanding what determines a company's fair price? So for the second factor, we use earnings yield. Okay, and earnings yield is actually the same thing as the price to earnings ratio, except it's the inverse of it. So it gives you the same information. So it's just the inverse of the price to earnings ratio, and we kind of saw that earlier, right, when we saw that the earnings yield of 20% was equivalent to a PE ratio of 5. And Greenblatt does differ in the approach, is that the way it's different to what we looked at before is that he uses earnings before interest and taxes instead of net profit in the numerator, and total enterprise value instead of just market capitalization in the denominator. Right, so instead of using the net profit that you would normally see in the earnings yield, we use earnings before interest and taxes. And instead of using the value of the market capitalization or the company's equity value, we use the total enterprise value in the denominator. So as per Greenblatt's equation, we have that the earnings yield is equal to EBIT, earnings before interest and taxes, divided by TEV, which is total enterprise value. So now our goal is going to be to understand a couple of things. First, what is total enterprise value? And why does Greenblatt choose to compare EBIT over TEV instead of PE? Right, so PE is something that we see a lot more commonly. So why exactly have we chosen this particular form of earnings yield? Let's go ahead and try and understand that. Magic Formula Stock Screener. So the total enterprise value, this reflects the cost an acquirer would have to pay to buy out the entire company. Right, so if someone wanted to go in and buy the entire company, the total enterprise value would be what they had to pay. So what is the total enterprise value? It's equal to the market capitalization, right, which is basically the value of the company's equity, the company's total debt, then subtracting cash and cash equivalents, and adding back minority interest and preferred stock. All right, so these components make up the total enterprise value. So the reason Greenblatt uses EBIT over TEV instead of PE is to facilitate a like-for-like comparison between all stocks irrespective of their capital structure. Right, so remember, capital structure is saying how is the company financed, and the companies can be financed by debt or equity. And the debt-to-equity ratio will kind of tell you what the company's capital structure is. And the PE ratio is sensitive to that, right? So if the debt-to-equity ratio changes, it'll affect the PE ratio even if, the underlying, otherwise the company hasn't changed. So with EBIT to TEV, the debt-to-equity ratio doesn't necessarily matter, so you can easily compare companies that have different capital structures. So when we use the PE ratio, we're comparing a company's net profits to its market cap, right? Because we're looking at just the value of the company's equity, effectively. So the market capitalization, unfortunately, does not provide you with any clue about a company's capital structure and how it finances its business. So in particular, if the company has a very small amount of equity, then the PE ratio is not necessarily going to be very useful. So it would make it difficult to compare companies that were debt-free versus company that had debt on their balance sheet. So on the contrary, whenever we use Greenblatt's formula, we're actually comparing EBIT, or earnings before interest and taxes, with the entire value of the company, right? It's taking into account both the debt and the equity of the company. So whenever we're comparing the valuations of a large number of companies using a screener, right, because companies have different capital structures, this formula can be more effective, right? And that's the reason we used total enterprise value. Magic Formula Stock Screener. So as we have discussed, Greenblatt's magic formula has two metrics. The first is the return on capital, and this we've defined as earnings before interest and taxes divided by net fixed assets plus net current assets. And the second is the earnings yield, which is earnings before interest and taxes divided by the total enterprise value. And then you can run these two metrics on all the companies in your set, right? You can sort companies by these metrics. And typically the way we would do this is that we would arrange the companies in their descending order of return on capital. Okay, and we assign rank 1 to the company with the highest ROC and go on assigning ranks in that order. And then we would carry out the same process for earnings yield. So, alright, we would rank companies based on their earnings yield. And once we have all the companies with the two respective ranks, the next step is to do a combined ranking. So Greenblatt assigns equal weightage to both ROC and earnings yield. So then all we have to do is sum the two ranks to arrive at the combined rank. Right, so that's because we weight both things equally, we can just sum them together and that gives us the combined rank. If it was the case that we thought one was more important than the other, then when we actually added them, we'd have to put more weight on one as opposed to the other. But because they're equal weight, we can just add them together. And as per Greenblatt, the lower the combined ranking, the better the stock. Right, so we've essentially ranked 1 to be the best company by both of these metrics. So the sum of the two ranks is the company's total rank, and the lower the number is, the better, right? The lower the number means it has, higher ROC and also higher earnings yield, right? So these are the two metrics that we look at, and then you can see the process to rank both of them and combine them is fairly straightforward. Magic Formula Stock Screener. Okay, so now what we have done is we have essentially applied this stock screener, and we have excluded financial companies from this list. So the first thing we want to do is look at the part about return on capital. So we want the great business, and we essentially have the EBIT over net fixed assets over plus net current assets. So we take the EBIT, net fixed assets, and net current assets, and then we calculate this value here, which is the ROC. And we have these for all the companies, and then this gives us the company's ranking in terms of ROC. The next thing we have is the total enterprise value, right? And then we calculate the earnings yield, which we've defined as EBIT over total enterprise value. And then again, we rank these with higher number getting the highest number getting rank 1, and so on and so forth. And then here we get the combined ranking where we just sum these two. Okay, so these are actually ended up being sorted by the combined ranking, right? So then this Bajaj Auto is first in the list because it has the lowest combined ranking. Okay, so as you can see, the Magic Formula Stock Screener is fairly straightforward to apply. You do need a few more items of information, so you do need a bit more things from the balance sheet or the income statements. So you need net fixed assets, you need net current assets, then you need earnings before interest and taxes. And then you also need the total enterprise value, and all that together will allow you to use this stock screener in order to rank the companies. Okay, so one of the limitations of the magic formula is that we do give equal weightage to return on capital and earnings yield. So it's not necessarily clear that this is always the right thing to do, but it seems straightforward in this case. But that is a limitation of this stock screener. And of course, another limitation is that the results only reflect the company's past performance. And that's the case actually with all these stock screeners. They typically reflect, previous earnings, and so on. If the company's fundamentals are deteriorating or its economic moat is eroding, then we have to take that into account, right? We have to think about, we need to think about whether these, return on capital and is actually sustainable in the long term, right? So that's important. Okay, let's now go back into the PowerPoint and we'll finish up the lecture. Things to keep in mind. So stock screeners are a great tool for picking stocks, right? It really allows us to filter a very large number of stocks into a list that's a lot more manageable. Whenever we use stock screeners, here are some things that we must bear in mind. The first is that stock screeners are statistical tools, right? It's basically just applying some kind of numerical algorithm to say, well, I want companies with only, dividend yields bigger than 6.7%, for example. Right, so they're not necessarily always reliable indicators of a company's quality and intrinsic value. Stock screeners are only based on a company's past performance, right? So all they do is indicate what the company has done in the past. They provide no input about a company's future prospects. Okay, so this is important. Obviously, when we do our analysis, when we're actually valuing the company, we need to take into account, how we think the company is going to do in the future. And finally, the results of the stock screener must not be taken as face value. That means you don't go ahead and just do the stock screener and invest in all those companies that you see. The stock screener is really a starting point for further research and analysis. So the purpose of the stock screener is to take a very large list of companies that would be too difficult for us to analyze, right? So if we had a few thousand companies, there's no way we could analyze all of them. Stock Screener is to bring that list from, say, 5,000 companies down to 20, 30 companies that we have. We can actually spend time and analyze each one in more detail. Right, so Stock Screener really is a starting point for the further research and analysis part. It's not meant to be, a way to actually pick what we're going to invest in. The advantage of the Stock Screener is that it's very easy to use. It's very quick. We can make that filter that list very quickly. But for that reason, it's also you can't invest just based on that, right? You have to do more research and more analysis. Conclusion. So this now brings us to the conclusion of our lecture. We've talked about stock screeners in this lecture, and we've seen that stock screeners are excellent tools to scan the entire universe of stocks and to find stocks that possess the attributes that you are looking for. Right? So based on your investment philosophy, you can actually customize these screeners to find the stocks you're interested in. And they're an effective tool to filter away undesirable stocks. Right? So in particular, when you're dealing with a very large list of companies, having the stock screener is very helpful in allowing you to take that large list and turn it into a smaller, more manageable list. And in this lecture so far, we've discussed 5 different stock screeners. The first 3 were based on the principles of Benjamin Graham. The last 2, including the magic formula, was based on Warren Buffett's principles. And if we use stock screeners diligently, we can yield great results, right? So it's definitely a very useful tool, and I encourage you to use it. So I would encourage you to go onto the Equity Master website, where you saw the link, which was in the Excel sheet, where you can look at the stock filter and the stock screening tool that we have, that you can actually just do it yourself on that. You don't have to worry about collecting all the data yourself. Okay, so this now concludes this lecture. The next module and lecture will be on behavioral finance. So we're going to change topics from this. And in behavioral finance, we're going to discuss the psychological aspects of investing and how investors can minimize biases and thinking errors from their investment decision-making process. So we'll look at some of the common issues that people face in terms of common mistakes that are made when we invest due to various biases. And these are due to psychological factors, which we'll talk about. And the purpose of this is to understand these errors that investors make so that you won't make them yourselves. And obviously, the less errors you make, the better your returns will be in the long run. Okay, thank you very much for listening, and we'll see you next time.